everybody. I wanted to talk about performance management. So let's go back in history a little bit to maybe before the 1970s. And let's say we're comparing the performance of Company A and Company B. Now, back then, the priority was to increase net income, increase profits. So anything you could do to increase profits, you did. So if you could sell some more by lowering the price or raising the price, or if you could reduce an expense, or if you could buy an asset that would make it go a little quicker, or it could produce more per minute, and therefore you could produce and sell more, then by all means you did it. Then in the 1970s, interest rates spiked. And so people became more aware of how expensive assets were. And so then the measure got changed to be return on assets. Now, which company is the same? When we were just measuring net income, Company A and Company B would have been evaluated as being similar performers. But now, they don't have the same level of assets. Now, how's it going to look? Let's do return on assets, sometimes also referred to as return on investment. So here's the formula in your textbook, but there's other versions of this. Sometimes net income is put as the numerator. Sometimes total assets or average assets are put in the denominator, and they don't carve out non-operating assets like assets that are being held for sale and are no longer used in the business, goodwill, or other items that are not considered central to serving the customer. So in a prior corporate life, I had a report with 3 different versions of return on assets because managers had different reasons for using one version of it for one purpose and another version of it for another. So this version that used operating income and operating assets was used for manager bonuses because it excluded interest and taxes and non-operating assets that the manager didn't have control over. But the classic return on assets that would include everything, net income and total assets, was used for external reporting and investor views and other stakeholders. So there's more than one version. But the idea is some measure of profit can be EBIT or EBITDA for you people in the finance class. So anyway, but it's some version of profit on the top and some version of total assets on the bottom. So let's calculate it now for Company A and Company B. So we would take net income, that's the only measure of profit they gave us, and then assets. And so we have 4% for Company A, and then we have 8% for Company B. So under this measure, Company B looks better. So this became now the metric of choice that we told the teams, please optimize that. And teams are really fantastic about that. If you tell them optimize net income, they do. If you tell them optimize return on assets, they will. So what are some ways you can optimize return on assets? Well, you can reduce assets. Wonderful. You can increase revenue. Wonderful. You can decrease expenses. Wonderful. Optimizing this metric, though, had some side effects, just like optimizing net income had side effects in that people thought assets were free and they were buying assets all over the place to get profits up, even if it wasn't a good return, even if the trade-off wasn't good. But the same thing can happen with return on assets. When I was a corporate controller in the field, we had 91 plants. And so when you start evaluating folks based on return on assets, they started selling off assets and renting them back. So expenses went up a little bit, but assets went down a lot. And so return on assets got better. But of course, when you're renting assets, you lose control over your ability to amend it. You're locked in for longer periods of time where you can't trade it in, upgrade it for a new change. It's not the same as owning it. So from a strategy point of view, that may not have been good, but they were certainly optimizing the metric that we gave them. Another thing that can happen with return on assets is your high performers start guarding their higher and higher return on assets statistics. And so they decline business that doesn't have an extremely high return on assets. And so they don't grow. We had a manager in Texas that had a very high return on assets. I think it was close to 17%. And he could pretty much eyeball a proposal and see were these high margin products that the customer was requesting a quote on. And so anything, he was cherry picking only the very high margin proposals to bid on because he didn't want his return on assets to drop. His bonus was based on return on assets because that's what he was told to maximize. So the best way for him to maximize it was to decline low margin business. Okay, so that wasn't really good for the strategy of the firm. And he would also send that low margin business to plants that weren't doing very well. So all your new customers were getting the rookie managers or managers that really were not performing very well. So it was not good strategy. So over-optimizing return on assets had some issues. And so the response to that was to introduce a new statistic or a new measure, residual income. Let's put that up here. So here's residual income. It takes operating income and subtracts a capital charge. The capital charge is calculated as the average operating assets times a minimum required return, expressed as a percent. And so you subtract that capital charge from operating income, and anything you've earned above the capital charge is called residual income. And so if you change the metric to optimize residual income, please, now all of a sudden that manager in Texas that had a 17% return is not rewarded based on the 17%, but rewarded on the maximum residual income. How much profit can you generate over this return required? Sometimes they're called target return. It can be called minimum return, minimum required return, hurdle rate, that sort of thing. So let's say the hurdle rate is 13%. Now, any project that has 13% is going to improve that manager's performance. And so they're not going to turn away business that's under 17%, just accept anything that's above 11%. And in fact, all the managers will decline anything below 11% because it'll make their residual income negative. And so that's a positive thing. It gives them a lower boundary to decline business altogether. So if they had a 2% return on assets, they're not accepting an 8% just to increase their return on assets when it's actually not very good for the company because they have figured out based on their cost of capital and their risk tolerance that they really need 11%. All right, so that's sort of the theory behind it. And let's do some examples in the next video.